Hi everyone, we are Group 5. Our presentation today will be focusing on analyzing bank run. In the first half, we will discuss the reasons why Ben Bernanke, Douglas Diamond, and Philip Dybvig won the Economic Nobel Prize in 2022. That unveils some of the fundamental factors that lead to a bank run. And then in the second half, we will use game theory to further interpret how bank run actually works in real life.
First, let's look at the reason why Ben Bernanke, Douglas Diamond, and Philip Dybvig were awarded with the Nobel Prize. Before Bernanke, Friedman attempted to conclude the causes of the Great Depression. He identified two primary ways that could lead to financial crisis: a decline in the money supply and a reduction in the wealth of bank shareholders. However, his theory falls short in explaining the downturn in overall output during the Depression. Bernanke was the first one who pointed out a third way, which is bank run. Given the incomplete nature of many financial contracts, banks play an important role in providing information and facilitating transactions. When these services are underperforming, it leads to a widespread panic. So Bernanke emphasizes on the important role of banks in the economy, and it laid the groundwork for the modern banking system that we operate today. Bernanke helped us understand the importance of banks, while Diamond and Dybvig helped us further understanding why banks are so important and how to protect them. The Diamond-Dybvig model illustrates the dual role of banks. Banks need to provide liquidity to the public while supporting long-term loans. Taking on two responsibilities at the same time exposes banks to more risks, which triggers bank run. So, deposit insurance and central bank support are necessary to maintain deposits confidence, preventing bank run. But government also needs to regulate banks in case they take on more risks, abusing government backstop. Moving on, we will map out banks' position in the economic system to show its vulnerability.
As we just mentioned in the Diamond-Dybvig model, they highlighted the dual role of banks. To give a thorough explanation of why this is a fundamental factor that contributes to banks' vulnerability and leads to bank run, we draw a map that shows the position where a bank sits in our financial market. We can see that a bank sits in between the surplus unit and the deficit unit as an intermediary. It channels savings from depositors to invest in productive businesses. So as a bank, it needs to meet the demand of liquidity, accelerate cash flow in the market, and also endorse qualified businesses that's worth the funding and ensuring sufficiency in the market. This forges a virtuous cycle, which I outline in green, that gives depositors confidence in the market and also trust the banking system. However, we can also see that there is a mismatch between the short-term liability and the long-term assets. This makes banks especially vulnerable to rumors. This is because this whole system only works under one assumption, that only a fraction of depositors will withdraw their money in a given period of time. That said, if there is a rumor about bankruptcy among the public, that will trigger everyone rushing to the bank trying to get their money out at the same time. And that breaks the crucial assumption, disrupt trust, and also turns a healthy market into a vicious cycle. Now you might ask a question. Does it mean bank run won't happen if everyone is rational, that we all don't withdraw our money and try to save the bank? The answer to that is no, because unfortunately, the only rational move when there is a rumor is to panic along with others. And I will explain to you why using a game theory showing how bank run happens between depositors. Let's first look at the assumption of our game. We have depositor 1 and depositor 2. They both have $1 million in their bank account. And we have two information. First, both depositors are aware that their deposits are insured up to $250,000 under the Australia's financial claim scheme. And the second information is that there is a rumor about bankruptcy. Entering our game, we can see that we have two equilibriums. And at first, the situation where both depositors don't withdraw their money and everyone saves their deposits might seem like the rational move, but it's actually not, because it is not stable. Let's assume if you are depositor 1, you decide to not withdraw your money, but the other depositor decided to withdraw his money, and that will leave you in the worst situation in our game, which you only get the $250,000 that is protected by the Australia's financial claim scheme, whereas the other depositor, he will save all of his deposits. So under the stress of the rumor, the only rational move for you is to actually panic along with other depositors, and that leads to our Nash equilibrium, which all depositors trying to withdraw their money, and they ended up with only a fraction of their deposits. Although this is a situation where depositors trying to avoid, it is still better than if they don't withdraw their money, but the other depositor do. So this shows why it is rational to panic along with others, and also shows the start of a self-fulfilling prophecy. Next, we will show you the seesaw battle between depositors and banks using game theory.
For depositors, the choice they face is whether to participate in the mass withdrawal. And for banks, the choice is whether to make a large cash reserve to respond to a mass withdrawal of its depositors. In this game, both sides need to make decisions based on their own interest. On the one hand, the bank needs to make a decision on whether to prepare a large amount of cash to respond to the bank run. If the bank knows there's going to be a run, they need to consider two factors. First, the profit that will be lost by preparing a large amount of cash. And the second one is, if the bank does not prepare enough money, it will face a certain risk of bankruptcy. Therefore, the bank needs to weigh the pros and cons and then make an optimal decision. On this occasion, we treat the bank preparation of cash as a positive response, and the vice versa as a negative response. On the other hand, the depositor's choice is not a key to game theory. If the depositor faces the risk of bank failure, and he will choose to make a mass withdrawal. If the depositor learns that another depositors also decide to withdraw their money, he may hesitate to join the run, because if he does not participate in that, he may suffer greater losses. And when the depositor knows the attitude of bank facing the run, it also affects their trust in the bank. And if it chooses to respond negatively, the depositors will choose to withdraw money in second time. Thus, depositors' trust in the bank is also a key factor influencing their decisions. And then let's look at two examples. The first one is the strong commercial bank. When the depositor wants to withdraw the money, the bank has two choices: respond with the positive or negative attitude. When the bank responds with a positive attitude, the depositor can withdraw the money and the bank gains the trust of its depositors. When it responds with a negative attitude, since it's a strong commercial bank, it also has enough cash for the customer to withdraw. However, in both cases, the depositor loses the interest on continued deposit with the bank, and the bank loses some of its profit due to the requirement to have cash on hand. When the customer does not want to withdraw the money, only the bank loses its profit if it chooses to respond positively. But if the bank chooses to respond negatively, it does not incur the loss, while the customer chooses to make a second withdrawal and loses some future interest income. The other one is the weak commercial bank. When a depositor wants to withdraw the money from a weak commercial bank, it incurs a loss whether it responds positively or negatively. If a weak commercial bank responds positively, the loss of profit from preparing cash is heavily low. And if the bank chooses to respond negatively, then the customer will choose to withdraw money twice, and the bank will face a bigger blow or even the risk of bankruptcy. When the run occurs, but the depositor does not want to withdraw the money, actually the ability of a weak commercial bank to cope with the run is questionable. So this choice may lead to even greater losses for the depositor. If the bank chooses to respond positively, the bank loses a small portion of its profit, and the depositor continues to bear the risk of the bank's insolvency. If the bank chooses to respond negatively, the bank incurs no losses and the customer may incur greater losses. As can be seen, a bank run is a process that involves multiple participants and multiple decision-making factors, and the interaction and game between the participants constitute multiple possibilities for decision-making. In order to avoid significant losses, the government, regulators, and banking associations should be involved in the gaming process and take measures to minimize the occurrence of runs.
In summary, the reason why Ben Bernanke, Douglas Diamond, and Philip Dybvig were given the Nobel Prize in Economics is because of their contribution in enhancing economic stability by helping us understanding and protecting the intermediary role of banks. And they also emphasized the significant impact of bank run, provided policy guidance to help us avoid financial crisis. Also, by illustrating bank run with game theory, it shows that altruism doesn't govern financial regulation. Instead, it is actually egoism that helps us truly understand how our financial system works.